Hello. I will start doing this type of charting sessions where I'm gonna go through maybe like old data. I will show you some things on the chart. I will teach you things, maybe like old price action. For example, today I'm going through what happened in Friday. So yesterday I basically did maybe like few mistakes on the chart, and I will also go through the Friday's price action and what kind of went wrong. I will basically just do a little bit of reflecting and also teach you some concepts. So this will be very beneficial for everyone to kind of learn. So let's start. All right, so let's start from Friday's price action. So daily time frame, where was price trading? You can see this massive bearish candle. That is the Friday's candle. And let's go to immediately like to hourly chart. Midnight opens here. I will put on the new week opening gaps, new day opening gaps on. So the red one is new day opening gap. Blue one is new week opening gap. And so, when market opens at 9:30 here, what I was kind of thinking was that we got some equal highs buy side in here and even here. And I was simply just thinking that there's a chance that market wants to go for that buy side, considering the fact that we are in Friday and we could be like bouncing away from this area here. So the premise was to kind of think of longs, but there also had to be proper amount of confluence to go long because we were dropping heavily from Wednesday to Thursday. In Thursday, I actually caught fairly nice long because I targeted just these highs here. So, but overall, we were still dropping in Thursday as well, and then Thursday evening, Friday night, we drop even further. Build some buy side here. So what went wrong here? Because I tried to kind of see if we could catch up longs into these areas here. What went wrong here? Because clearly the bias was incorrect. Market actually ends up dropping like absolutely massively, like massive drop. All right, so what did we have? Well, we got these equal lows here. Yeah, we swept that with like 2 points or something, but that's not good enough. Like when you're having like important like daily low, I would say that's a daily low there. Like 2 point sweep is not enough. Like that's equal lows still. That's still equal lows for me. And some more equal lows down here, which we didn't quite reach. But the thing in here is that, we are still bearish. We have bearish price like lower. We chop higher. This area in here is very congested. And it just means that there is a lot of movement in this area. It's price action has delivered efficiently, and that's why these gaps, they are called inefficiencies, because price action delivers inefficiently in these areas. And what does price like to do when you have inefficiencies? Price likes to revisit them, whereas with efficient price action there are no inefficiencies. And they are usually these type of congested areas that price could come up to, but price could have real hard time passing through this. So, and that's exactly what we found here. Price came here and puts on a rejection candle. All right, so it was kind of bad idea to look for longs because, well, first of all, I'm quite sure we had some type of minor SMT here that could have easily resulted in short ideas. I believe it was this one. This is probably the SMT, if I remember correctly. All right, so we put on SMT, we kind of start moving lower, And it's not like we only have the buy side. We also have like equal lows with this low and this low here. So that's sell side in itself. But you know, one thing that kind of got me got me tripped up was that we also put on like SMT like this or something like. And because I was bullish for the highs here, I was kind of thinking that okay, we got the SMT, maybe there's a chance to go long. And yeah, I ended up executing something. It wasn't anything crazy, and I was able to manage the trade after it got a little bit too much bearish confluences to go against my trade. So I just closed the trade with minor loss. Not the full TP, sorry, the full stop loss didn't get hit there. So in my opinion, I managed that very well. But I will go through that real soon. Currently, it's just these lows, and so mainly looking at this now, you know, we were when I tried to see the reaction out of here, like that was fairly reasonable to think to see like a retracement higher because we were trading in Newwick opening gap, New Day opening gap, and there was a lot of these same gaps above here. So there was a chance that market would have wanted to revisit those areas. So in my opinion, the idea of longs isn't like fully bad. It's just that we are kind of like bearish here. So maybe the best idea would have been either to look for shorts after we saw something like sweep here, or then if market just gives enough bearish confluence, just go short immediately without really having to see a buy side sweep here. All right, then yeah. So I can remove those Newwick opening gaps and such. So market continues to drop, then we can drop into the lower time frames because I identified these pools. So what happened in the session when I was trading is that, you know, I was maybe a little bit too fixated on the highs, these short-term highs here. I didn't really pay attention to these lows, for example, which I should have done. All right. And even like here, let's in this instance, the New Day opening gaps are not that important in my opinion. So we can just look at the Newwick opening gaps. We got like a massive Newwick opening gap here. Price comes to that, and what happens? We can investigate this. So trades to CE rejects. Okay, bullish sign maybe. Yeah, we come back to that. Consolidate around. Okay, now we want to see maybe a bullish reaction. Market fills the new opening gap. That's a good sign. All right, and we can even measure the area between two new opening gaps. So this is actually called event horizon. That's ICT PDRA. So that's 50% level between new opening gap. In this instance, it's this one down here and this one up here, and that's the 50% here. And you can see where price rejects. That's exactly around that 50%. So that's actually very interesting, and that's why one of the reasons why event horizons are very good. You can see even the 1 minute candles respect that event horizon very closely. That's algorithmic in my opinion. All right. So what happened here is that we got the new opening gap. As told, we respect the CE a couple of times. Then don't even reach the CE, respect that, but we fail to go higher. We build liquidity to both sides here. What happens? Market sweeps the sell side that we built here, fills the new wick opening gap, after which it runs for the other side of the liquidity and taps the event horizon. Now that we have tapped the event horizon and swept the buy side, if market is bearish, this is really the point where the rejection should happen, and we should start trading lower. So what happens when you're looking at this bullish price legs, you really want to investigate if you see any fair value gaps or such, which we don't see. Like in 15-minute chart, we don't see many. I would note these two gaps here. They are small, but they are still notable and like useful. And let's just leave this one because this is the one that is respected nicely. So we flip that gap and put on like a nice bearish fair value gap. This is the point where you can start looking for short ideas. The PM session then builds some sell side here, equal lows, a lot of equal lows you can see. And we manipulate initially a lot, but this is where you can utilize the market on close macro, because you can find like 1 minute ICT 2022 model entry here and target the internal equal lows here, and that could be amazing trade. And that's the market on close macro that closes on 4 p.m. All right. So this is the first kind of sign that market is starting to flip bearish again. Reaction out of event horizon starting to trend lower. We broke structure to the downside in the market on close macro here. So that's break of structure to the downside. What happens then? We chop around, and before we see another drop, I would prefer to see, sweep of the highs. But okay, in this instance, we didn't get that, so we get a continuous drop, and market almost like leaves these highs. Like when we are trading down here, if market isn't really bullish, these highs are far high up here. Like market actually doesn't have to take them out. Like market can leave the highs here and run for them maybe like next week or something like that. So keeping that in mind and keeping the bearish kind of ideas in mind still, I should have looked for the lows here. All right. So what happens actually? Let's investigate this a little bit more. So when we in the market on close macro, we drop below the C of the new week opening gap, and what happens? Price starts respecting the lower part of the gap, and it never really breaks back above. It starts respecting this CE, and with these new week opening gaps, you also want to look for the quadrant level, so 0.25 and such. And you can even see this lower quadrant. The majority of the time is used and spent in this lower quadrant here. All right, so price is starting to show that, okay, we are breaking below the new week opening gap and starting to respect it like this. We break below the new week opening gap, break of structure, and the reason for that is very obvious. We got new week opening gap here that we want to fill. That's done now. All right, when that happens, we break back higher, or rather just put on like a retracement. And what happens after that retracement? We start going back lower, but fail to take the loan, and now we got equal highs and equal lows here. And now we come to the session that in which I made the kind of mistake. Although it isn't that much of a mistake. Like there are a couple sides of the coin, but basically, let me just see why this doesn't show up. I don't know, but anyhow, market goes just at the market open 9:30 happens in here. So market immediately goes lower, sweeps the low in here. These are the equal lows. And so, there is actually, like, I'm not gonna lie, there is fair amount of evidence at this point that market could want to go for the buy side here. And that is exactly the reason why I went into longs. I saw a flip of this gap and I just executed for that because for me that was good enough evidence to run for the highs and maybe then extend the price run to there. So what's happened? Market didn't really do anything specifically good. We got initially good reaction out of here, but massive candle to the downside immediately. And whenever you see this very good reaction out of your area and then even more massive candle to the downside like that, that's 100 times out of 100 like a bad sign, very bad sign for your trade. That's either indicating that you're just wrong with your idea, or that even if you're correct, price action is going to be high volume, very choppy, and the candles are usually, in this instance, they are large and the risk levels are getting elevated and price action is not clean. It's like high resistance liquidity run. So if you don't know what high resistance liquidity run is, it's basically just that market isn't moving cleanly. It's kind of chopping around, and maybe like, let's say this is your target and this is how price moves. Low resistance liquidity run, it just makes clean leg higher, clean leg higher, clean leg higher, reaches all your targets. Your high resistance liquidity run would be like clean leg higher, massive leg lower again, then we kind of chop around like this and maybe come close to the high but kind of fail to sweep it, and then we kind of just make another drop, and it's just price action that doesn't print much fair value gaps, price action that isn't really clean. Alright, so here the first red flag was actually that the buy side of the curve here, which flipped the gap. Alright, we got the gap flipped, but price actually, the buy side leg actually didn't print any bullish fair value gaps. So that was actually a red flag for me, because you kind of have to put on like a bullish fair value gap to be absolutely convicted with a long idea, in my opinion. Or at least like a very clean inverse, let's say good inverse on this candle. That would have been more convincing. But okay. So how I managed it was that I went to 3-minute chart. We flipped the 3-minute bullish gap in here. So that was actually this one. That's a busy. So we flipped that. That's becoming an inverse. And I just closed the trade on that candle close there. So that was fairly well managed. I was able to cut my risk or the loss maybe by half, Well, what happened then? We push again higher, again investigating the wicks. In this case, it's not any higher time frame wick, it's just 3-minute candle wick, so you don't have to look for the quadrants. Equilibrium is just fine. So the equilibrium of that wick, market rejects exactly there. This is how you measure ranges in price. Look for the wicks, look for different PD arrays, measure them. Market rejects from that. And this is now the scenario where I should have executed for the shorts, because there was the equal lows there that I marked out, and it's this as the sell side. These are far down here. I don't really actually care about that. So market ends up dropping heavily. Looking at the 1-minute time frame, there aren't really many type of entries, but there's really only one entry that I can really think of, and it's this one here. So executing from that fair value gap, I wouldn't have done that or from that fair value gap low, and I wouldn't have done that because I don't want to have almost 70 points stop. So what I would do is, when this happens, I would execute from a PD array that I can find from this area here, and that in this case we got propulsion block here. And you can just execute from, I would realistically go for try to execute from this area here, and then especially because of the fact that we got the sell side is far down, we got a lot of kind of like potential to drop. So that's the reason why, all right, having larger stop loss could be like total fine, because you are also making more money. So also don't exceed your risk management plan. But all right, so that was kind of the plan here, or that's how I should have managed the trading day. Seeing like this 3-minute wick market rejecting exactly from the CE, putting on some bearish signs. We already got this bearish overall trend. We already got things like market starting to respect some of the new wick opening gaps. We got things like SMT here, and when I like to trade the break of structures, this isn't really a good break of structure here. I got in the longs because we got the inverse, but this isn't actually a good trade in terms of the fact that really the only structural high that we broke was this one, and it happened only after I had got in like a long time ago. And to be totally transparent, this type of trade would be fine if I just was correct with my buys, which I wasn't. So I don't want to like tell that I was breaking my rules, because I didn't technically break any rules here. I don't have any like hard rule whether or not I need like a fair value gap in this type of price, like, but maybe like a little bit more discretion in this. I should have understood that maybe going for a long isn't the most ideal situation here. All right, but trying to learn from every day from the price action. And let's say you're trading the ICT 2022 model. You want to see break of structure and fair value gap. Really, there is no way you are getting long, because price doesn't give that type of chance. And really, the only short you can really have is this one. So if you trade the ICT 2022 model strictly, you're basically not going to lose today, and this would be perfect day for you. Like if you are capable of identifying the correct direction of the price action, you are going to make money these type of days. So I would totally say that I managed the thing fine at the end of the day, but I will have to kind of learn from these other things. The main problem again in here was that my bias was wrong. So it's important to kind of develop yourself, learn from the mistakes, and even if you don't have mistakes, go through the trades and see what you maybe could have done differently. You know what I'm saying? So, for example, as I told, this one isn't really a mistake, as in that I executed due to my plan. I executed how I should be executing, but and I managed to trade how I should be managing that, as in that when we closed the 3-minute fair value gap inverse, that I cut my loss so that I didn't lose the full position. But maybe other thing that I had was that after I lost there, I was still a little bit too fixated on the longs, and I almost just looked for the longs and didn't even consider shorts. I didn't consider them at all. So maybe the problem there was also that I was maybe a little bit too married with my kind of the initial idea of the market, and didn't give any consideration to other side of the market. A very important thing to notice here is the first percentage fair value gap. So it's kind of small, but it's respected perfectly, and this is the area where you should have got in the shorts, because we don't only break the low in here, break the structure there, we also flip and inverse the first fair value gap, and that's very good sign of, you know, bearishness. And you know, just getting into shorts from the first fair value gap is usually something that I love to utilize first percentage fair value gaps in both in entries and with the targets. So yesterday was very good for me in terms of the fact that I did a couple of mistakes, but you know, price actually was fairly clean. Like, it was kind of choppy in this area here, but silver bullet came and, you know, price action delivered fairly cleanly. So I should have just been more fair with considering my daily bias, because, you know, I'll tell you what happened. So I basically opened the charts, and you can see this from my yesterday's video. So what happens is I put on the recording, I get into the charts, and what do I see? I see equal highs. I'm like, okay, I'm going for the longs. That's my bias for the day. So I didn't really consider that actually that much, but looking at the daily time frame, there is a real reason to go short for shorts. So that's definitely something I should have considered a little bit more. So really the lesson of the day is that consider both sides of the market. Don't just try to be, or don't just be like one-sided. Don't get married with your trade ideas or setups, and also cut your trades early if you have any type of protocol for doing that. When market is getting or giving you evidence that it's probably going to run against you, try to cut your trade early. And other thing as well, if you start realizing that you're probably incorrect with your bias, it's good to try to learn how to kind of flip your bias. Because let's say my bias is long. When market gives this kind of confluences that it's willing to go short, it's very good to be kind of flexible with your bias and kind of understand that, okay, clearly my bias was wrong. I can still make money on the day because market is starting to show bearishness, and we got some ideas that would support bearish price action. So yeah, there's a couple of ideas from yesterday, and yesterday was, well, I didn't make any money, but it was maybe like the best trading day for me last week, because, you know, I always love the days when I'm doing some mistake and I'm getting the opportunity to learn from that, because, you know, those kind of days, they do happen often, but they don't happen every day. And, you know, the days when I don't make any mistake and I don't necessarily learn anything new, or I don't have to consider anything new, you know, they feel good because you're making money and you're winning. But these are really the days when you're growing, when you're making yourself like better trader, you know what I'm saying? So if you don't utilize these type of days to learn what went wrong, I'm afraid to say that you're not going to become very competent trader, because these markets are brutal and you always have to learn new things. So that's the first episode of my charting session. I think these type of discussions are very beneficial for everyone, especially if you're unprofitable. These kind of things kind of, you know, show you how traders use things in practice, and how they, and in this case, how I consider things when they play out, and how I also reflect on my past performances. And you can learn a lot from these type of videos. Also about price action, I talked about event horizon and forming your bias and stuff like that. So, and how price likes to move around new company gaps. So I would recommend you to subscribe my channel, like the video, share for fellow traders if you have any, and join my Discord. That's the link on the my YouTube bio. So that's all for today. Thank you for watching.